Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
Welcome back to the deep dive. Okay, I want to start today with a little scenario.
All right, I'm listening.
Imagine you've got two companies. Company A, they have the absolute best product on the market. It's sleek, it's beautiful, customers just love it.
Okay.
Then you have Company B. They have the hardest working team you've ever seen. People grinding 80-hour weeks, sweating every single detail. Just flawless execution.
Right, the hustle team.
Exactly. Now, if you had to bet your life savings on which company wins over the next 20 years, which one are you picking?
That feels like a trick question.
It is a trick question.
Because usually the answer is, you want both. You want the amazing product and the hustle.
You do, but according to this stack of research we've been digging into, neither of those things is the main reason the true titans win. We tell ourselves these stories, about visionary products or this legendary work ethic, but the sources we're looking at suggest the real secret sauce. It's actually kind of boring.
It is incredibly boring on the surface.
Yeah.
Until you look at the bank account, then it gets very interesting.
Exactly. The topic today is capital allocation. And before you hit pause, because that sounds like the title of some dusty textbook.
Oh, no, it's not the sexiest title.
It really isn't, but hear me out. The whole premise here is that how a company spends its money is maybe even more important than how it makes its money.
That is the core argument, and frankly, it's one of the most misunderstood concepts in business. We're pulling from resources on corporate finance excellence, strategic allocation, and a ton of case studies. Amazon, Berkshire, Apple.
Right.
And the takeaway is just startling. You can have a mediocre business with world-class capital allocation, and it can totally outperform a great business with terrible allocation. It's the invisible engine behind every headline.
It's also the reason giants like, say, General Electric completely fell from grace. So our mission today is to decode this engine.
Let's do it.
We want to unpack how leaders decide where to put the money, why doing nothing is sometimes a superpower, and see if we can apply this to our own lives.
And we should be clear, this isn't just for CFOs.
Right.
If you manage a budget, a team, or even just your own household finances, this $1 rule applies to you.
Okay, let's start right there. The $1 rule. I saw that phrase everywhere in the literature. It sounds simple, but I'm guessing there's more to it.
It's the fundamental law of gravity for finance. The rule is this. Every single dollar a company generates has a lifespan.
And it can only be spent once.
It can only be spent once. Once it leaves the bank account, that's it. It's gone. You can't call it back.
Right.
And it sounds so obvious, but you'd be shocked how many executives act like capital is infinite. The rule forces you to realize that where that specific dollar goes determines the long-term future of the company.
It's the ultimate opportunity cost.
Precisely. The sources draw this line between operations and allocation. Operations is the hard work of making the dollar, right?
Selling the widget, serving the customer.
Exactly. Allocation is the strategic work of deciding where to put that dollar to make it multiply. Weak allocators just, throw money at operational problems.
Yeah.
Strong allocators treat that dollar like a precious seed.
So if I'm a CEO or just anyone managing resources, and I've got this dollar sitting here, what are my actual options? It feels like there are a million things I could do with it.
It feels infinite, yeah. Marketing, hiring, parties.
Acquisitions.
But the capital allocation toolkit that our sources describe really only has 4 levers.
Yeah.
And this was a huge aha moment for me. All the complexity boils down to just 4 buckets.
Okay, let's walk through them. Where can the dollar go?
Bucket number 1, reinvestment. You put the dollar right back into the engine.
R&D, new factories, better logistics.
Hiring more engineers. You're basically betting that the dollar will make the core business stronger and bigger.
Okay, bucket 2.
Mergers and acquisitions.
Yeah.
M&A. You take the dollar and you go shopping. You buy another company.
That's usually the most exciting headline, but it's also the riskiest.
Extremely risky. And we will definitely get to that. Bucket number 3 is returning capital.
Giving it back.
You look at the dollar and you say, look, we don't have a high return way to spend this inside the company, so we're going to give it back to the owners.
A dividend, or you buy back stock.
Exactly. And the 4th,
What's left?
balance sheet management. You just use the dollar to pay down debt. That's it.
Wow.
Every financial decision you read about in the news is just a CEO choosing one of those 4 buckets.
That makes it sound so manageable.
Right.
But the pressure has to come from the trade-offs, right?
Yeah.
How do you even know which bucket to pick?
That is the million-dollar or, billion-dollar question. And this is where we have to introduce a term that is the absolute North Star for these decisions, ROIC.
Return on invested capital. I saw that acronym everywhere. Can we translate that into plain English?
Sure. Think of it as the yield on your effort. If you put $1 into a savings account right now, your ROIC is what? Maybe 4 or 5%?
Safe but low.
Very low. Now, if Amazon puts $1 into a new warehouse, they aren't doing it for fun. They calculate that the warehouse will generate, let's say, a 20% return every year for the next decade.
So the CEO's job isn't just spending. It's looking at those 4 buckets and asking, which one gives me the highest ROIC?
Exactly. They have to be agnostic. They can't just love building factories because it's what they do.
Yeah.
They have to ask, if I buy a competitor, will I get a 10% return? If I build a factory, will I get 15%? Well, you build the factory. And if the answer to both is 0,
You give the money back to the shareholder,
you give it back. It requires checking your ego at the door.
which has to be the hardest part.
Oh, absolutely.
Okay, let's get out of the theory and look at the scoreboard. I want to unpack this with real companies because the sources lay out this fascinating spectrum of styles. Let's start with the reinvestment kings.
Okay.
The sources point to Amazon as the ultimate example of bucket number 1.
They are the textbook definition. And to understand why Amazon is such a powerful case study, you have to remember the narrative from the early 2000s. Do you remember what people used to say about them?
Oh, vividly. They called it a charity, Amazon.org.
Yes.
People joked that Jeff Bezos was allergic to profit. Every single quarter, they'd report these huge revenues, but barely any profit. Wall Street hated it.
Wall Street was screaming, "Show us the money." But looking back at the data now, we see that Bezos wasn't bad at business. He was just operating on a completely different time frame than everybody else.
He was playing a different game.
He was, and he was making a distinction that's really crucial for our listeners, the difference between accounting profit and cash flow.
Okay, break that down for us.
So Amazon was actually generating massive amounts of cash from selling books and electronics, but instead of keeping that cash and reporting it as profit, which means you have to pay taxes on it, maybe pay dividends,
Right.
he took almost every single dollar and poured it right back into the business immediately.
Into logistics, warehouses.
And crucially, into technology. This is where the $1 rule gets so interesting. He poured billions into servers and infrastructure to build AWS.
Amazon Web Services.
Yeah, which at the time must have looked completely crazy.
Oh, yeah. You're a bookstore. Why are you building server farms?
Exactly. It was a huge capital-intensive bet. In the short term, it made Amazon's margins look terrible. It made them look like a company that couldn't make money. But Bezos knew that the ROIC, the return on those server farms, would be astronomical in 10 years.
The sources call this prioritizing durable competitive advantage over short-term earnings optics.
Earnings optics is such a great phrase. It's about looking rich versus actually building wealth.
Right.
Bezos didn't care about looking profitable in 2005. He cared about owning the infrastructure of the internet in 2015.
And it worked. I mean, AWS is practically the engine of the modern web.
And it generates the bulk of their profit today. That is the
Yeah.
power of aggressive, high ROIC reinvestment. But, and this is a big but, it only works if you have great ideas to spend the money on. You can't just spend for the sake of spending.
Which brings us to the other end of the spectrum.
Yes. The do-nothing strategy.
The strategy that requires nerves of steel.
It really does.
We're talking about Berkshire Hathaway and Warren Buffett. Now, usually when we think of a powerful CEO, we think of action, speed, move fast and break things. But the sources describe Berkshire's strategy as extreme patience.
It is the art of patience. And honestly, it is psychologically brutal for most leaders.
Explain that. How is sitting on your hands a strategy?
Well, imagine you're a CEO. You have billions of dollars in the bank. Your shareholders are watching. The media is watching. Everyone else is out there buying AI companies or merging.
Right.
You feel what the sources call the institutional imperative. It's basically peer pressure to follow the herd.
You feel like you need to join the party.
Exactly. It burns a hole in your pocket. But Berkshire operates differently. They have an extremely high threshold for what they consider a good investment. They call it the fat pitch, like in baseball.
Right. In baseball, you don't have to swing at every ball. You can stand there and wait for that perfect pitch right down the middle. In business, Buffett says, I have a strict standard, and if I don't see a company to buy that meets my standard, I will simply wait.
So they just let the cash sit there.
They let it pile up. I mean, sometimes tens of billions of dollars just sitting in short-term treasuries earning very little.
But isn't that bad? Doesn't inflation just eat it away?
That's the standard argument, yeah.
Yeah.
But Buffett views cash as a call option on the future.
A call option.
He knows that eventually a crisis will happen, the market will crash, and when everyone else is broke and desperate to sell, he'll have the cash to buy incredible companies for pennies on the dollar.
That is fascinating. So Amazon is always spend to grow, and Berkshire's never spend unless it's a slam dunk.
Precisely. Both are disciplined, just in totally different ways. Amazon is maximizing growth, Berkshire is maximizing safety and opportunity cost. But what happens when a company grows up? I'm looking at the notes on Apple here, and it feels like they break the mold. They aren't just reinvesting like Amazon, but they're not just holding cash like Berkshire either.
Apple is the case study for evolution. This is what happens when you win the game so big that the rules actually change for you.
What do you mean by that?
Well, just think about the scale. Apple generates so much free cash flow, we're talking nearly $100 billion a year at times, that they physically cannot reinvest it all back into the business.
Right. There are only so many iPhones you can make. If they try to spend $100 billion on R&D, they'd just be lighting money on fire.
Yeah.
ROIC would drop to zero.
Exactly. The law of large numbers kicks in. So Tim Cook and the finance team did something that looks simple, but was actually a massive shift in strategy.
Okay.
They moved to bucket number 3, returning capital.
The dividends and buybacks.
Specifically, massive share buybacks.
I want to pause on buybacks for a second. Because in the news, buybacks often get a really bad rap. People hear it and think it's just financial manipulation to pump the stock price. But from a capital allocation perspective, what is the actual logic?
It's a simple math equation. Think of the company as a pizza cut into 8 slices. You own 1 slice.
Okay.
If the company uses its cash to buy back 2 slices from other people and just retires them, the pizza is now only 6 slices.
And my slice just got bigger relative to the whole pile.
Exactly. You own a larger percentage of the company's earnings without doing a thing. Apple basically realized, our stock is undervalued, we have way too much cash, the single best investment we can make is in ourselves.
So it wasn't a sign of weakness, it was a sign of efficiency.
Correct. But the key nuance with Apple and why they are such a success story is that they did this alongside reinvestment. They didn't stop building the Vision Pro or the new chips.
Right.
They had enough cash to fund the future and reward the shareholders.
It's not an either, it's a balance.
It shows that capital allocation isn't static. It evolves. When you're a startup, you're Amazon. When you're mature, you might look more like Apple.
Okay, we've seen the heroes. Amazon, Berkshire, Apple. They all used the toolkit differently, but they used it well.
Yep.
But this is a deep dive. We have to look at the other side of the coin, the train wrecks.
We have to. It's where the best lessons are.
The sources point to General Electric GE as the ultimate cautionary tale. And this is tragic because GE used to be the standard for American business excellence.
Oh, absolutely. They invented the light bulb. They were the original blue chip stock.
So what went wrong? Looking at the autopsy and the source material, it's clear their failure wasn't just bad products. It was a catastrophic failure of capital allocation.
It was. They fell into the trap of empire building. They became obsessed with bucket number 2, M&A.
Buying companies.
Buying everything. Under previous leadership, specifically the Immelt era, GE was buying water treatment plants, movie studios, insurance companies, energy grids, you name it.
They called it diversification.
The critics now call it diversification.
Ouch.
They spread their capital so thin across businesses that had no strategic cohesion. That's the key phrase from the text. The people running the movie studio had nothing to do with the people making jet engines.
But why is that a failure of allocation?
Because of the price they paid. The sources point out that GE had a habit of buying at peak valuations. They would buy an oil company right when oil prices were at an all-time high.
Buying high, the cardinal sin.
And buying high and using debt to do it, they were leveraging the balance sheet to fund this massive sprawl. So imagine paying top dollar for a business that generates a low return. Your ROIC, that magic number, starts to plummet.
They were getting bigger, but the quality of the business was getting worse.
Exactly. They confused growth with value. And when the market turned and those businesses stopped performing, the debt became an anchor that just sank the ship.
It's really a lesson that scale doesn't save you.
No. The insight here is so critical. Scale and growth do not compensate for weak capital discipline. You can be the biggest company in the world, but if you allocate capital poorly, you will destroy value.
That is a heavy lesson. Returns matter more than size.
Always.
Want to bring this into the modern day. We have a case study here that feels a little bit grayer. It's not a clear hero or villain story yet.
No, it's not.
It's Meta Platforms Facebook.
Oh, this is the most controversial one in the stack. It's a real-time drama.
It feels like a conflict between the cash cow and the big bet.
It is. On one side, you have Meta's core business advertising on Instagram and Facebook. It's a machine. It just prints money with incredibly high ROIC.
But then you have Reality Labs, the metaverse.
The black hole, as some investors have called it. Mark Zuckerberg decided to take billions of dollars of that ad revenue and pour it into this massive long-term bet on VR and the metaverse.
And investors hated it.
They revolted. The stock crashed a couple of years ago because of it. And this highlights a really modern challenge in allocation: return visibility.
What does that mean?
Well, when Amazon built a warehouse, investors could do the math. One warehouse equals X packages equals Y revenue. It's visible.
Right.
With the metaverse, it's pure speculation. Investors are looking at that spending and asking, is this money just gone forever? Is this a brilliant AWS-style move, or is this a GE-style vanity project?
It's the uncertainty.
The market loathes uncertainty. The takeaway here is really about communication. If you're going to make those long-term, high-risk bets, you have to earn the right to do it. You have to clearly articulate the framework, or the market will punish you.
So bringing this all together, we've got the reinvestment kings, the patient savers, the balance giants, and the cautionary tales. What does this actually mean for the people doing the work, the finance teams?
It changes the definition of the job. If you work in finance or if you're a leader, your job isn't just to report the numbers.
Okay.
Your job is to challenge assumptions.
Challenge assumptions.
Yes. The sources emphasize that strong finance teams act as a check on the system. They ask, is this really the best use of our $1? They ensure capital is deployed thoughtfully, not just reactively.
There's a maxim in the text that I love. Discipline matters more than precision.
That's the golden rule. It is so much better to be roughly right and disciplined than to be precisely wrong and reactive. You don't need a perfect crystal ball to predict the future price of a stock. You need a strict process for how you make decisions so you don't do something stupid in the heat of the moment.
I love that. It's not about predicting the future. It's about preparing for it with your resources.
Exactly.
Now, I want to pivot for our final thought. We usually wrap up with a business takeaway, but as we've been talking about this $1 rule, I can't help but feel it applies to us personally.
I was thinking the exact same thing. The parallels are hard to ignore.
Think about it. We are all capital allocators, but instead of millions of dollars, our capital is our time and our energy.
And just like that dollar, an hour can only be spent once. Once 3:0 p.m. is gone today, it is gone forever.
So if you looked at your own life through the lens of these case studies, who are you?
That is a confronting question.
Are you in Amazon? Are you in a phase of aggressive reinvestment? Spending your free time learning a new language, getting a certification, building a side project? Are you willing to look unprofitable in your social life right now for a big payoff in 10 years?
Or are you a Berkshire? Are you practicing extreme patience? Saying no to 100 mediocre invitations and distractions so that you have the energy banked for the one thing that really, truly matters?
Or, and this is the scary one, are you a GE? Are you diversifying your life? Are you trying to learn guitar and train for a marathon and start a podcast and renovate your house all at the same time? Are you spreading your resources so thin that you have no strategic cohesion?
That hits home. Personal ROIC. If you're exhausted but not getting anywhere, you might be suffering from bad capital allocation.
Companies don't succeed just because they work harder. They succeed because they invest smarter. And maybe we should too.
Couldn't have said it better myself.
A huge thank you to the listeners for diving in with us. Take a look at your own buckets this week. We'll catch you on the next deep dive.
See you then.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.